Okay, so we'll start with introduction to firm and market organization. Okay, so this extra class today we'll try to complete within say 90 minutes. Okay, and because this is a short chapter, so we'll be able to do that, I think. Now, one important thing I want to point out, I think there are a lot of inconsistencies in this chapter. The authors, although they have tried to present the information as consistently, as correctly as possible. But I think there are inconsistencies, especially with respect to mathematical formulation and some ideas which have been given in the book, which are technically, if you apply the core mathematics and just see the technicalities, they are completely actually incorrect, okay, on some parts. So we'll discuss those things as well also, and what kind of uh, care you should take, okay, while understanding those concepts, and what should we do if suppose those kind of things, although prerequisite is not directly tested in the exam, but at least related concepts can be tested, right? Which we are going to do in the core reading. So whatever inconsistencies are there, now with respect to those inconsistencies also, how do you adapt in the exam? That also we'll discuss, okay? So we'll start with the learning outcomes. So these are the 6 learning outcomes that we'll try to cover today. Characteristics of these 4 types of market: for perfect competition, monopolistic competition, oligopoly, and pure monopoly. Then price relationships between price, marginal revenues, marginal costs, economic profit, and elasticity of demand. Now, this part is going to be very similar to what we have done earlier. Okay, so whatever we have done in the previous class, so we'll extend that and we'll try to find out these relationships. Then we'll introduce supply function also. Again, it will also be in somewhat, you can say, parallel to what discussion we have had regarding the total cost and marginal cost. And we'll extend it to the firm this time. Then optimal output, pricing strategy under each market structure. Mainly, the curriculum covers the pricing strategy under perfect competition and monopoly. So the intermediate structures, actually, monopolistic competition and oligopoly, have not been discussed properly in this chapter. Okay, so whatever is there in the curriculum, we'll stick to that only. And then long run equilibrium. Okay, so let's start. Okay, now what is the market structure? When we talk about market structure, what are we exactly discussing? Now, market structure, it defines a firm's strategic options, you can say. Sorry, yeah, strategic options, and it guides the analysis of pricing and profitability. So it is a strategic environment, you can say, under which the firm is operating, and it tells the firm how much flexibility it has, okay, in setting the prices, how much competition level there is, how aggressively the firm must compete, and what are the types of decisions that the management can pursue in a realistic sense. Okay, so it is very important for the firm that it understands this market structure, okay, which it is a part of, because the pricing behavior and the ability of the firm to generate profits will be decided by these market structures. Now, in markets where you have a lot of competition, okay, highly competitive markets, long run profits, they are driven down by competition. Okay, so long run profits, they will tend to fall towards a normal level, because competitors will quickly, imitate successful strategies, increase their outputs, maybe lower their prices. Okay, so all these activities of competitors, they will actually reduce profit margins overall. But of course, as the markets become less competitive, um, and we'll see the characteristics, lower number of firms, stronger barriers to entry, greater product differentiation, all these things. In those cases, large profits are possible even in the long run, because there is a lot of pricing power that companies can preserve. And all these things will be discussed in detail. Now, economists have defined 4 types of market structure. So basically, what is a market? A market is simply a place, you can say, where you have buyers and you have sellers who can interact, they can agree on a price, they can exchange information. Okay. Now, this interaction between them is, you can say, the interaction, basically the ability to communicate with each other and do transactions with each other. That interaction forms the basis for analyzing any kind of market structure. Now, of course, structures will be different, right? Not all markets will operate in the same manner. Okay, some will have many firms, okay, with lower concentration. So based on concentration, product differentiation, entry barriers, market structures will actually differ. Okay, and these differences will determine how competitive the market environment is. So four primary forms we are going to see, four classic structures. One is perfect competition, then you have monopolistic competition, oligopoly, and monopoly. Okay, so each structure will be a bit different from each other. They will have different landscape for competition, and of course the pricing power and everything. The interactions also will be a little different. Now, market structure influences how broadly or narrowly a market is defined. See, if you want to define the market, that definition itself, it requires some kind of judgment. Okay, you have, for example, nowadays what we are seeing, there are many markets which are, which operate globally, especially the digital markets. But if you have markets like the cement market, quick commerce, as we are seeing a lot in India, okay, uh, these are actually constrained, at least to some extent, geographically. Of course, that same company can also have operations in multiple cities, that is okay. But the domain of a single center is actually restricted geographically. Now, as say training providers for CFA, FRM, all these exams, we fall under the, you can say, digital landscape where we are not that much geographically restricted. Okay, because we have candidates who are based in India also, then many of our candidates who are based outside of India also. So we are not constrained geographically. So how broadly or narrowly we will define the market, that definition will influence the structure of the market and the intensity of the competition, you can say. Okay. So perfect competition. So perfect competition is at, you can say, one extreme end of the definition spectrum, you can say. So you have a large number of firms. They sell identical products with no pricing power. So no single firm has any influence over the market price. Each firm, you can say, is a price taker. That is what we call them, price takers. Okay. So profits are driven to normal returns, because if they try to get a higher return by going for a higher price, buyers will simply go elsewhere because the product is the same everywhere. Okay, last class also we were discussing a real world example where we were discussing agri based commodities, agricultural markets, right? Wheat, rice, corn, all these things. So if you have a kilogram of wheat from one farmer, or say a quintal of wheat from one farmer, that is essentially identical to that from another farmer. Of course, there are grades in wheat also, but as a class, as a whole, if suppose we are talking about a single grade of wheat only, then of course the quintal of wheat from one farmer will be same as a quintal of wheat from another farmer. So that is why in such markets, the firms can only have normal returns, okay, in the long run, because free entry and exit, they actually push the profits down. Then you have monopolistic competition. Okay. So in this, you have many firms. In monopolistic competition, you have many firms, and each of the firm is having a little differentiated product, little differentiation. Okay, it can be higher degree of differentiation also, but it can also be little different. Generally, it is little differentiation. Okay, that differentiation can come from different aspects. It can be because of branding, it can be because of quality difference, it can be because of advertising or even packaging. Okay, or even customer experience, you can say. So in perfect competitions, what we were seeing that the firms have no pricing power. But in case of monopolistic competition, the firms will have some pricing power. Okay, because there is some level of uniqueness. Okay, consumers, they prefer, uh, they may prefer, you can say, one brand over another brand. Okay, you can have examples like restaurants, clothing brands, Okay, different salons, all the, even cosmetic brands, cafes, all these are examples. So of course there are many sellers, many restaurants are there. Okay, but each restaurant or each salon, they'll feel unique enough to charge their own price. Okay, but still in this case also the entry into the market is not very difficult. Although it's not as easy as perfect competition. Again, even in perfect competition, if you see agricultural based commodities, because acquiring land and irrigation facilities are not easy, right? But in cases where land is available and there are no issues with irrigation, which is the case with many developed countries like the US, there uh, the participants, participants who have access to this free land and irrigation facilities, that there is no barrier for entry. I mean, very little barrier to entry. In monopolistic competition, there will be some barrier to entry, but not too much. Okay, so overall, you can say even for this market, entry is relatively easier. Okay, so that is why in this case also, of course, there is some pricing power. There will be a little above normal returns, but still long run profits will still move towards normal returns only. But of course, different firms will try to compete with each other through various kinds of innovations and product differentiations. Okay. Next, we have oligopoly. Now, oligopoly is basically uh, we are actually going from left to right and we are uh, moving further and further to the right side along the spectrum, right? We have reached this third kind, which is oligopoly. So you have a few large firms which dominate the entire market. Okay. And of course, since each firm is large, uh, their pricing decisions, their output decisions, they will actually affect each other. Okay. So the strategic pricing decisions will have to be, anticipated, considering the reactions of their competitors. That is important. And that is why uh, oligopolies actually create, you can say, either stable prices or price wars. Okay. Although it is not a oligopoly. If you talk about the telecommunications industry before the entry of Geo, okay, even after the entry of Geo for a few years, you can say it was kind of a oligopoly. Okay, although it is moving more towards a monopolistic market only, but it was kind of all because there were a few players. At least there were 5 or 6 players, right, private players, and there was a massive price war after that. In smartphones, you can say. I mean, there are not too many players. I mean, which are massively known worldwide, right? We have say uh, iPhones are there. We have Apple for iPhones, and then we have for Android, we have the biggest player is Samsung, let's say. So of course, we know that there are massive price wars between. Uh, at least we can say under Android only. Let's not consider Apple and Samsung. Let's consider two other companies who are say operating in India and who are selling only Android phones. So of course there is a price. There has been a lot of price war. There have been phases. In fact, there was a phase where there was a massive price war going on between Samsung and Vivo. Okay, for mid-range phones. Then between OnePlus and Samsung for a little, you can say, mid to high-range phones. Okay, so this is also an example of oligopoly. Then even in airlines, if you see in India, I mean, how many players are there? In fact, in any country, you see there are not too many players in airlines. Very few players are there, and they dominate the market. Okay, next you have monopoly. So in monopoly, you have basically just a single firm, single seller. Okay, it supplies the entire market, and there are no close substitutes. And of course, there will be high barriers to entry. Okay, this gives the monopolistic firm or monopolist, you can call it, massive pricing power, substantial pricing power. And it is often actually regulated. Monopolies are often regulated. Okay, you can take examples. You have electricity distribution is one of the classic examples that we always give, right, for monopolies. Rail services also. That is, I mean, in India, if you see, it's monopoly, right? A single player is there. It's still not privatized. Then even at a city level. if this may not be true for a country level, but at a city level, if you talk about water facilities and sewage facilities, even that is a monopoly. Okay, in most of the cities. Okay, also it can also come because of patents. You can have a pharmaceutical company which has a patent. That will also be a monopoly. Okay, so monopolies can arise because of patents, because of control over some very, very important resources. Okay, or maybe even government regulation. It can also, like for example, in rail services in India. Then it can also happen because of natural conditions, natural monopoly conditions, we call them. Because in those cases, actually, it benefits the society to have a monopoly where large scale production will lower the cost. Okay, because the initial cost is so high, it is actually better to have a single firm invest everything, okay, properly, and then wait for a long run, a long time to get break even and then earn normal profits. And also it also benefits because it can reduce complexity sometimes. For example, with the situation which I was discussing with respect to local level, for water supply, sewage utilities. If there are say more than say 5 or 6 players who are doing water supply in a city, there will be a lot of complication also, right? Apart from investment, initially all of them will have to invest heavily, but apart from that also there will be a lot of complication. Mapping mapping of connections, then uh, the crossing over of connections. What kind of permissions each firm has, maybe some amount of say land has been acquired and there is some construction going on over there, and some digging work needs to be done. Now one firm has already done the digging up work, the other firm will also want to supply through that route. So this actually creates a lot of issues, it can create a lot of complications. That is why it is always better for sometimes to go for natural monopolies. Okay, so these four structures, they actually, what is the difference? If we summarize the difference, uh, basically you have the number and size of firms. Okay, so the number of firms and the relative size, that is different in each structure. In the product differentiation, the degree of product differentiation is different. Okay, pricing power is different. Entry and exit barriers, the relative strength of barriers to market entry and exit is different. Okay, and non-price competition is also different. So if you want to compare the four market structures with respect to these factors, okay, let's do that. So with respect to these factors, this is the comparison. So in case of perfect competition, you have many sellers, no product differentiation, products are homogeneous, very low barriers to entry, okay, and the pricing power is none for each firm. The level of non-price competition is zero. Then the second market structure is monopolistic competition, where you have many sellers, but there is some level of differentiation. Barriers to entry are quite low. And there is some, you can say not considerable, but at least some pricing power with each firm. Then you have the degree of non-price competition. In this case, there is some level of non-price competition through advertising and product differentiation. Okay. Then you have oligopoly. Here, the number of sellers are few. Product differentiation, again, either it will be homogeneous or it can be differentiated. Barriers to entry are high. There is some or considerable pricing power. Non-price competition is same as monopolistic competition. And finally, at the other end of the extreme, you have monopoly. Number of sellers, actually, it should not be few, it should be very few or one. Okay, so let me just change this. Let me just write one or very few. It means one or two, basically one, two. Okay, so that's a monopoly. Generally, it is one. Okay, then the product will be unique. No close substitutes are available. Barriers to entry are very, very high. Pricing power is considerable with each firm. And of course, product differentiation can be done, sorry, non-price competition is done through advertising, which just matters over here, not to, you know, because this non-price competition is not against the competitors because there are no competitors. This is just for brand recognition, long-term brand recognition, okay, long-term brand recollection, that's it, and long-term brand building, nothing else. Okay, now The trade-offs, what are the trade-offs in the market structure? So let's understand the consumer perspective. So from a consumer standpoint, obviously the ideal market will be one with the greatest degree of competition, right? More competition will mean lower price and higher output, and of course greater access to um, uh, goods or services, whatever that market is operating for. Okay, then if you look at the firm's perspective, the opposite is true actually. They want greater pricing power, which is actually found in monopoly and oligopoly. Okay, it actually allows the firms to earn larger profits. Okay, and maintain their position, strong, competitive, advantageous positions. Okay, and of course there is a innovation trade-off. This is an important trade-off. Now, many innovations actually they require substantial investment. Okay, especially in the fields of technology, pharma. Okay, all these things they actually medical innovations they require a lot of investment. So obviously firms will undertake these kind of investments, okay, if they have the expectation of attractive returns, okay, which is acceptable in oligopoly but not in perfect competition. So this balance between competition, profitability, uh, and innovation, okay, that balance explains why no single market is just best, you can say, for all stakeholders. All the markets are different, and each of the markets will offer different advantages and different kinds of trade-offs. Now let's start with perfect competition. As we discussed earlier, that there are large number of potential participants, okay, many potential buyers and sellers in the markets. Products are identical, offered by sellers are virtually identical or homogeneous, low entry barriers, no pricing power, and no non-price competition. So example, we discussed agricultural industry, say for example corn for animal feed. Okay, so a bushel from farmer Brown is identical to any bushel from another farmer Lopez, let's say. Okay, now let us discuss this important relationship between elasticity and revenue, and this is where I believe that CFA Institute authors have done a little mistake, okay, in terms of technicality, but overall the idea is not incorrect. Okay, so these are the three conditions that they have given. And when we write EP greater than 1, understand that we are implying mod of elasticity, because it can be positive and it can be negative also, because own price elasticity is generally negative, right? So for normal goods. So this is mod. Basically, we are discussing about the absolute value or the magnitude of elasticity over here. Okay. So we know this, right? That if the demand type is elastic, then the elasticity magnitude of the elasticity is greater than 1. We have seen this in the last class. Okay. Now, what they imply over here is that when demand is elastic, we have seen earlier that consumers will be highly responsive to price changes, right? Because in elastic, when the demand is elastic, if you increase the price, if you remember what happened, if you increase the price, actually quantity demanded will decrease much more, okay, in terms of proportion, okay, as compared to the price increase. So because that is the elastic region, if you remember, that was to the left of the midpoint in the demand curve. We'll come to that also later on, but if you remember from the last class, it was on the left side of the midpoint. So what happens in elastic demand? When elastic demand is there, you have the quantity demanded, it will actually drop by a proportionately much larger amount as compared to the price increase. But on the other hand, if a price decrease happens, okay, the quantity demanded will increase by again a proportionately larger amount. Okay, so that is the case when we talk about elastic demand. So if you extend this relationship, if you apply this relationship and try and calculate total revenue, what they say that, see, total revenue is a product of what? Tell me. Total revenue is a product of price and quantity, right? And in a very simple relationship. So when we talk about total revenue, I say it is nothing but price times quantity. So the authors say that if the demand is elastic, then if the price increases a little bit, quantity decreases a lot. Okay, so one increases, the other decreases. Okay, but this increases less and it decreases more in percentage terms. So overall their product decreases because whichever effect dominates more, they both are in multiplicative terms, right? P as well as Q, they are multiplicative terms. So if one of them is increasing, the other is decreasing, you need to find out which effect is dominating more if you want to comment anything on the total revenue part. Okay, so to decide which effect is dominating more, we look at the elasticity part. So if the demand is elastic, we know that a little price increase, say only this much, I'm just symbolically I'm drawing the arrow, will reduce the quantity by a large amount, say this much, which means that any price increase will lead to a decrease in total revenue because this effect is dominating. The decrease effect is dominating. Okay, and vice versa will also be true. Any decrease in price will increase the total revenue. I'll tell you what is the flaw in this argument. Okay, this is mostly correct, but there is a technical flaw. For the second case, unitary elastic. Now, in case of unitary elasticity, we know that the percentage change in quantity demanded, it actually exactly offsets the percentage change in price. Because if suppose my E is equal to 1, it means delta Q in percentage terms, okay, divided by delta P in percentage terms. So I can write delta percentage P, that will be better, I think. So delta percentage Q, delta percentage Q divided by delta percentage P is equal to 1. So which means that they both are equal, right? And in fact, remember, actually it is minus 1. That is why I'm saying it's mod. If you remember, elasticity was negative, own price elasticity was negative. So let me just write minus 1 also so that it is more clear to you. This is where I think, I mean, they should have written minus 1. They should have at least written mod. Again, the things that have been explained, again, the candidates will interpret if they read the prerequisite reading directly from the book. I mean, they will again misinterpret that elasticity is actually greater than 1. No, we all know that own price elasticity is equal to a negative number. So it is equal to minus 1. So obviously in this case, delta percentage Q is equal to negative of delta percentage P. So any increase or any change in the quantity demanded, it exactly offsets the change in percentage change in price. So if the percentage change in quantity is 10% increase, the percentage change in price will be 10% decrease. So they will offset each other, which means that the product will be same and there will be no effect in the total revenue part. Now, the flaw in this argument is it is mathematically inconsistent and incorrect. Why? Let's say we take a percentage change because these changes are in percentage terms, not in absolute value or say even if it was in absolute value terms, even then it would not have worked. Actually, it would have required a different kind of analysis. Some other thing should be added over here. But anyways, we'll stick to this part only for the curriculum. But what is the flaw? Let's say there is a 10% change in the price. Price increases by 10%. So can you tell me if price increases by 10%, if the earlier price is P, if it increases by 10%, what should I write for P? New P is equal to how much? New price is equal to what should I write? What should I multiply it with to show an increase of 10% mathematically? Tell me.
1.1.
Correct. 1.1 times P. So they say that if percentage change in price is say 10%, according to their argument, if the elasticity is negative 1, can I say that the quantity demanded will be reduced by 10%? So which means that Q will decrease, Q will decrease or Q decreases by 10%. So can you tell me what is new Q?
0.9 Q.
Very good, 0.9 Q. So if you multiply 1.1 P and 0.9 Q, how much you're getting?
0.99.
Exactly. You get 0.99 PQ or 0.99 TR because PQ was equal to total revenue, right? PQ was equal to total revenue. Is it the same as the previous TR? No, it is now different. It is not TR, but it is 0.99 TR. So you will say, what is the problem, sir? It's still acceptable. It's very close, right, to 1. Agreed. But what if the increase is by 50%? Then what will happen? Tell me what will be new total revenue in terms of the previous total revenue. Think about it. Price increases by 50%, quantity demanded decreases by 50%. So price becomes 1.5p, quantity becomes 0.5q. So can you tell me what will be the new total revenue quickly?
0.75.
Exactly. So is it the same as the previous total revenue? Of course not. So it is mathematically inconsistent. But again, since they have mentioned this, if I also said that what you should do from the point of view of the exam, so probably they have not considered these mathematical inconsistencies, and they are assuming that maybe the price increase and decrease will be in a very narrow region. But even if it is the narrow region, even if it is in the narrow region of 10% or 5%, even then it is not correct. It's still close. It's not 100% correct. So maybe that mathematical part has not been considered at all. Maybe they have been, I'll say, just based on logic, they have applied it. Okay, that the price revenue relationship will be no change in TR for the second case, but it does not work like that. So if the second case is mathematically inconsistent, the first and the last are also mathematically inconsistent. But from the point of view of the exam, this is what you're going to remember, that if the elasticity is unitary, then any price change, whether it is increase or decrease, results in no change in total revenue from the exam point of view. But please remember that this mathematical part is also there. Okay. Next, total revenue is maximized when marginal revenue equals to 0. Of course, if marginal revenue is equal to 0, it means that you have reached the point of maximum total revenue. In the last class only we have done this. What was marginal revenue, if you remember? Marginal revenue is nothing but the revenue from each additional unit. Okay, so of course, as long as marginal revenue is positive, each additional unit sold, it actually adds to your revenue. So once your marginal revenue becomes negative, obviously there is a subtraction and total revenue becomes lower. Okay, total revenue becomes lower, it starts to decrease. Okay, now there is a relationship which has been given, okay, and it can be derived easily, although it will not do it in the class because it's not there in the curriculum. So you have to remember this relationship, that marginal revenue in terms of elasticity, if you want to link marginal revenue to elasticity, it can be linked to elasticity through price. So basically MR is equal to P, where P is the price, multiplied by 1 minus 1 by elasticity times P. Okay, so this relationship, it not only identifies uh, the, uh, the point at which you can say the revenue is maximized, but also it guides the pricing strategy as well. Okay, now if you operate in the elastic region of the demand curve, okay, then based on, again, I'm not talking about, I think I'm not talking about this relationship right now. I'm saying this, the basic relationship that we discussed, these relationships, it actually uh, guides you regarding the pricing strategy also. Okay, because if you are in the elastic region, now with respect to strategy, how will you apply it? Okay, if you're in the elastic region, you know that if I raise the price, that will reduce my total revenue. Okay, because of this reason, because the quantity demanded, it falls proportionately more. Okay, so this relationship, this table, it actually provides or it guides the firm regarding pricing strategies as well. Okay, yeah, strategic pricing decisions. Okay, and the predicting the impact on total revenue. Now let's talk about consumer surplus. Nice. So small, actually, the dot when that is set to a pointer, that is sometimes invisible. So consumer surplus is the difference between the value the buyer places on units purchased and the amount the buyer pays for those units. It arises when willingness to pay is higher than the market price paid. Okay, so think of a situation where, let's say, you are ready to pay 100 for something, a good or a service, but that good or a service, that product is actually available, say, for 70. Okay, so that difference of 30 is actually your surplus. So surplus is coming from paying less than what is your maximum willingness to pay. Okay, now the demand curve can be viewed, or it can represent the consumer's willingness to pay for each additional unit. So that is why we interpret it as a marginal value curve. Okay, so the y coordinate or the height of the curve at any point, it will tell you that how much the consumer values the additional or the next unit. Okay, and of course, because valuation, okay, because value of additional units, they actually decrease with each extra unit that you have. That is why the demand curve slopes downwards, and we have seen why the demand curve slopes downwards earlier also. Okay, this is one of the other reasons, you can say, value point of view. Now if you want to measure the total value, okay, a consumer gets from, say, buying Q1 units. This is the demand curve, which we interpreted as the marginal curve, marginal value curve. And if you want to measure the total value that a consumer is getting from buying Q1 units, it is the area under the demand curve up to Q1. So this entire dashed area, okay, where you have vertical lines, that is your total value that the consumer is getting. Okay, total value, you can say that of the full bundle of Q1 units. Okay, now if you compare this total value to what the consumer is actually paying, okay, then you will get the consumer surplus, because the consumer is paying P1. This is what the consumer is paying at quantity P1, Q1. But any units before Q1, okay, consumer was willing to pay more. But as we are moving down the demand curve, it means that for every unit, okay, let's say Q1 is equal to 10, for example. So for 10 units, for all the 10 units, the consumer is paying less. But if suppose there were only 5 units, then the consumer was willing to pay much more, higher than P1. Okay, but if the firm is supplying now 10 units, it does not mean that the firm can say, okay, for the first 5 units, since you were, willing to pay me more, so for the first 5 units, I'll charge you something higher than P1, and then for the next 5 units, I'll charge you P1. No, for the all the 10 units, the firm will charge P1 to the customer. So this difference between the total value and the total price that has been paid, because P1 times Q1 is the total price, right? That the consumer has paid, and this is the total value. So this region now, the shaded rectangle, triangle, sorry, rectangle, not triangle, the shaded triangle. So you can say everything above this price line, but below the demand curve, up to Q1 is the consumer surplus. Okay, so this shaded triangle region, it shows the extra value that consumers are enjoying because the price for many units was lower than what they were willing to pay. So let's take an example. So let's say this is the market demand function. Okay, you have to find out the value of the consumer surplus if the price is equal to 40. Okay, so I'll start, and let's say if you guys can just give me the final answer. So let me just start. So I know that this is my QD. Okay, so at price P equal to 40, what will be my quantity demanded? 270 minus 123 times 40 is 120, which will be 150. Okay, it will be 150. And again, I'll write the equation as 270 minus 3P, because I'll just use this to find out P in terms of Q. Because if you remember, the curve, the demand curve is the graph of the inverse demand function, which is the graph of P versus Q, not Q versus P. So I'll take it to the other side. I'll get P is equal to 90 minus 1 over 3. QD. Okay, so if suppose I want to find out the consumer surplus, okay, basically it will be the area of this triangle. Okay, anyways, I'm showing it to you, so no need to calculate. So it is the area of this triangle. Okay, so area of the triangle above the price of 40 and below the demand curve up to the quantity 150. Okay, which is the area of the trapezium AOCD minus the rectangle BOCD. Okay, so of course I don't need to calculate the area of trapezium and rectangle separately. I can just use the formula of area of triangle, which is half times base times height. Base is 150, BD, height is 90 minus 40, which is 50. So it gives you 3750 is the consumer surplus. So will it be, I think in the exam, if at all consumer surplus is asked, I don't think any other figure apart from triangle or rectangle will be. You don't have to calculate the area of anything. Just remember the area of the triangle. Again, we have done this in school days, but if at all you have forgotten, half times base times height is the area of a triangle, right angle triangle in particular. Okay, but even if it is not a right angle triangle, generally you will have a right angle triangle, but this area formula is actually valid even if it is not a right angle triangle, although we won't see such cases. And the area of a rectangle was nothing but base times height or length times breadth, whatever form is given that you have to use. Now let us see the supply behavior and market supply for perfect competition. Okay, so we have seen for a single firm, we have seen that it is important that the firm tries to maximize their profits. Now, what will happen to the market supply? Okay, of course, the market is a collection of all the firms. Okay, so firms they actually expand when price rises. So if you have perfect competition, then uh, say if we have individual farmers, okay, two individual farmers, let's call them say Mr. Miller and let's call the other Miss Rivera. Okay, so Mr. Miller and Miss Rivera, they respond directly to market price in case of perfect competition. If you have the price of corn, which increases say from $3 to $5, this example we are directly taking from the prerequisite. Okay. Say from $3 to $5, if the price increases, both Mr. Miller as well as Miss Rivera, they will have a strong incentive to expand their output. Okay, because every additional unit of output will now result in more revenue for them. Okay, so basically, any firm is going to adjust production purely based on profitability. Okay, not any ability to influence prices. Okay, of course, if they have the capacity, that is also important. But to increase output, the farmers have to bring additional resources, right? Maybe they have to cultivate land plots which are much less fertile. Okay, they have it, but those land plots are much less fertile as compared to their current land in which they are producing. Maybe they have to install more irrigation facilities. They have to apply more fertilizers. Okay, and as you add these extra resources, generally they are more costly and less productive. And we have seen that earlier also. In the last class, we were discussing this that there is some kind of diminishing marginal utility and okay, diminishing marginal returns. Okay, the best things you have already utilized in the beginning. You have a decent capacity, but let's say if you want to expand, then the marginal cost, that means the cost of producing an additional unit, it will actually rise. And that will explain why the firms do not just produce unlimited quantities at even very high prices in perfect competition, because it's going to be very costly. The marginal cost is increasing. Okay, so the individual supply curves, they actually slope upwards. Okay, so this rising marginal cost, this is what gives each firm an upward sloping supply curve, because a firm will produce or supply higher. Okay, we have these two examples, so Miller and Rivera. So, and of course, similarly, you have other firms as well. A firm will produce higher only when price increases, because these prices will cover the increasing marginal cost of producing those additional units. Okay, if the marginal cost was not increasing, then even for these individual firms, the supply curve would not be like this. If suppose the marginal cost was constant, then at the same price, they could have produced unlimited quantities as per the demand in the market. So it would have been horizontal line, no problem at all. Okay, but that is not the case. If they have to increase the quantity because of increased demand, the price has to increase, and that is what we see generally in the market. Okay. Now, what is the market supply? Market supply is the sum of all firms' supply. So when you add the supply structure of all these firms, when you aggregate the supply structure of all the almost identical or similar firms, okay, you have Miller, you have Rivera, and you have many other firms. Okay, then you obtain this market supply curve. Okay, and this market curve will actually shift more towards the outside as more firms will increase their production at higher and higher prices. And of course, that is why if you have increase in demand from new buyers, that will raise the total market output by a large extent. Okay, and if you take example of in fact uh, corn, uh, suddenly if new buyers come into picture, for example, I think in India, if I'm not wrong, we were seeing right a lot of push towards ethanol production, right? In the last, in fact, we have seen this in the last 1.5 years. In fact, there have been a lot of policy, and the transport ministry has also been criticized because of that by many experts, right? The use of ethanol, and there has been a massive push towards that. Because of that, the demand of corn, by ethanol producers, it has actually increased, and that will mean that the output for corn will increase significantly, right? Economic cost, they will include opportunity cost as well. You remember from the last class, we have discussed this. Accounting cost was something else, economic cost was something else. Just like accounting profit versus economic profit, you have accounting cost versus economic cost. Economic profit as well as economic cost, they include opportunity cost. What was opportunity cost? The value of the next best alternative. Okay, it can be the next best alternative of labor, it can be the next best alternative of land, even for capital. Okay, so that is also in the economic cost. So that is why, since economic cost is uh, including the opportunity cost, these implicit costs, you can say, obviously economic profit will be very different from accounting profit. Now let's talk about equilibrium and the competitive firm. So let's just understand this by considering an example. Let's say you have a supply function. Okay, it represents the market supply. So collective output decisions of all producers. Okay, so basically uh, QS is equal to 50 plus 5P. So as the price increases, there's a plus over here. The total industry output also increases because all firms will respond to this opportunity for higher profitability of producing those additional or extra units. So obviously the price will increase. Now, if you change this, if you want to represent price as a function of quantity to find equilibrium, so we write it in inverse form. P is equal to 0.2 times Q minus 10. Okay, so over here you see that again in the supply, you have a positive slope. Okay, so as output grows, as Q increases, then since the marginal cost will increase, the industry will supply more amount only if the price also increases, because of course the positive slope tells you that the price increases. Okay, so that price increase will compensate for the rising costs. Now let's say this is the demand function. Okay, again we invert it and write it like that. Okay, So basically, if you remember, the maximum price, what does this function represent? The maximum price that the consumers are willing to pay for each unit. Okay. And of course, it is declining as quantity is increasing. So the first one, this is the supply function, this is the demand function. If you invert it, you get the inverse supply function, you get the inverse demand function. So what will be the condition for equilibrium? For equilibrium, the inverse demand should be equal to the inverse supply. So you just equate these two, 90 minus 1 over 3 Q, inverse demand is equal to inverse supply. So can anyone solve and tell me what is the value of Q that you are getting? I'll wait. Please solve and send me your answers for Q. Basic calculation. Anyone who solved it? It's very basic. Just take the numbers to one side, the variables along with the coefficients to another side. Okay. In fact, to make things simple, you can write, if you want, just as an approximation, you can write 1 over 3 as 0.33. It will make your job easier up to 2 decimal places or up to 4 decimal places, whatever you want to write. Or else you can write 0.2 as 2 by 10 or 1 over 5. Whatever suits you, you can do that. No problem. Okay. So, okay, one answer I've got. Q as how much? Okay, let's see. Okay, other is getting 188. Okay, 188. Anyone else who can confirm?
Yes, close enough.
Close enough.
187.5.
Great, great. Okay, fine. So, yeah, correct. Absolutely correct. So 187.5, you can round it off to 188. Okay. So this is my equilibrium quantity. That's why I'm just taking some liberty and using a star. Okay. To denote that this is an equilibrium quantity. Q star is equal to 187.5. So similarly, what is the equilibrium price? Just substitute this Q star over here to get the equilibrium price. Can you tell me what is the equilibrium price? What is the equilibrium price?
$365.
365. Okay, can you check? Because if you multiply 0.2,
Okay, 0.
okay, which means you are dividing it by 5, right? So
Yeah,
it
yeah,
should
yeah.
be less.
Just
Yeah.
checking.
Yeah. Okay, Adil is getting 27.6. Okay. Okay, one more answer. Vivek is also sent. Okay. Okay, Vivek is also getting the same answer. Okay, fine. Correct. Okay, so it's 27.5. So Adil, yes, if you use 188, you'll get 27.6. If you use 187.5, you'll get 27.5. That's absolutely correct. So this is my equilibrium price. Okay. So the competitive firm's price, it becomes actually the firm's horizontal, this competitive price becomes the firm's horizontal demand. So see, in perfect competition, we have seen that each firm is actually, since there are too many firms, each firm is too small, right, to influence the price as a whole. Even if you have a, say, we were taking the example of, say, corn, right? Even if you have Mr. Say Miller or Miss Rivera, if any of them is a very say rich, wealthy farmer, and they have the capacity to double or triple their output also, but still their market share, maybe it will increase from 2% to 2.5, 3%, 4%, max to max. Okay, even that is an exaggerated figure, which I'm even 2% is too much in a perfectly competitive firm. Even the market shares are much less. Okay, so each firm is too small to influence the market price, because if any single firm, even if they increase their output double, triple, whatever, the overall market quantity will change hardly. And the price will still remain almost 27.5. So that is why we call that the firms are price takers. Okay, and that is why at this level the demand curve actually becomes horizontal at 27.5. The firm's demand is actually horizontal at 27.5. Now it is important to understand that for this firm, price will be same as average revenue, which is the same as marginal revenue. And again, this is in continuation with whatever we have done earlier. Okay, because whatever extra unit the firm is selling, since for every single unit the price is the same, so obviously even if you produce 100, 200, 300 extra units, the price for every single unit is the same as 27.5. So the average revenue will always be 27.5. Average revenue means what? Average revenue means total revenue divided by total quantity, right? That is your average revenue. So revenue per unit. Okay. And what is the meaning of marginal revenue? Extra revenue per unit. Even that is the same. Okay. Or you can say revenue per additional unit. That is actually a better way to say it. Revenue per additional unit or revenue per extra unit. Even that is going to be 27.5 in case of perfect competition. So every unit the firm is selling, it is earning the same 27.5. Okay. Now the cost structure. Now to understand how uh, any competitive firm will decide the output, we have to understand the cost structure in a for a perfectly competitive market and for a competitive firm. Okay. So average cost and marginal cost, they are actually shaped by resource use and technology. Okay. Now, any farmer, let's say we're taking the example of farmer only, right? What resources they are using? They are using land, they are using labor, they are using capital, right? And under capital, of course, they'll use capital to buy tractors, to have the irrigation facilities constructed, or even recurring income, recurring cost of water supply, then fertilizers. All these things are requiring capital. So how the resources are used, how these resources are combined, of course, along with the available technology. Okay. Nowadays, we have a lot of agri-based technologies as well. Okay. So how these resources are combined along with the available technology, that is what decides the cost curve of these firms, the average cost as well as the marginal cost curve. Okay. So this kind of structure actually we get where we see that average cost falls initially and then it rises with diminishing returns. Now, one thing I just want to again reiterate, this is exactly in line with what we have done in the last chapter. See, first I'll show you the next point also. Marginal cost falls and then increases more sharply. Okay, so the behavior is similar. But if you remember from the last class, we had the minimum point was a very critical point, because whenever this marginal cost is below the average cost, whenever the marginal cost is below the average cost, so it is actually below the average cost till this point, till the minimum point of the average cost curve. So till this point, you can see average cost will continue to decrease even though marginal cost has started to increase. Okay, but still, since it is below average cost, the average cost is still decreasing, although slowly now. As soon as marginal cost crosses average cost at the midpoint of this curve, then the average cost also starts to increase, which makes sense, which makes a lot of sense. So same logic which we applied earlier. Okay, in the early stages, the output is low, but the fixed inputs are already in place, like tractors, irrigation facilities, they're already in place. And as you add more labor, okay, these fixed resources are used more efficiently That is why the average cost is falling and the marginal cost is also falling. But of course, after some point, what we discussed, diminishing returns. And this diminishing returns, it actually takes effect. And then the additional labor which we add, it produces smaller increases in output because these fixed inputs have actually been utilized in the most efficient manner already. Okay, now either you need to expand the scope of the business of the firm by maybe acquiring more land and setting up more facilities, but given those fixed inputs which have been utilized to their most in their most efficient way, now your marginal cost and average cost are starting to increase slowly. Okay, and this part is important. This minimum point of average cost is important because this is where marginal cost will intersect the average cost. And we have done this in the last class in the context of revenue. We did this in the context of revenue first and then in the context of cost. Okay, fine. Now, when we talk about profit maximization, okay, we know that the firm is going to take the market price as the horizontal marginal revenue. Okay, now for profit maximization, it happens when marginal cost is equal to marginal revenue. MR is equal to MC or MC is equal to MR. Okay, and this is the point. You have this is the marginal cost curve. This is the marginal revenue curve, which was the price curve, right? 27.5. The same thing. P was equal to AR equal to MR. So this marginal cost, when it intersects the marginal revenue curve, and this is a basic principle which we'll apply almost everywhere for profit maximization. Of course, there will be some exceptions, there will be some adjustments that we'll do, but this is a very basic fundamental principle that marginal cost is equal to marginal revenue, MR is equal to MC or MC is equal to MR, which happens at point A. Okay, so this is actually, this point is giving you the optimal output of the firm. This is QC, quantity QC is the optimal output of the firm. Okay, now let's talk about profits. If price is greater than minimum average cost, then the firm earns economic profit. Okay, so at output QC, we will compare the price with the average cost. Okay, so basically you have, this is the price which we know that it is at point A, but this point, the average cost at this particular quantity is point B. Okay, this is the average cost per unit of QC, quantity QC. So obviously the firm will earn a positive economic profit if the price is above this average cost, which is actually true in this case, because the average cost is denoted by this point P, which is your AC1 average cost at QC. So average cost at QC is this, whereas price is a bit higher. Okay, so you have your economic profit as total revenue minus total cost at QC. And it makes sense because this is your total revenue, price multiplied by quantity, which is the area of this rectangle. This is price. So height of this rectangle is price. This is the width of this rectangle QC. So obviously the area of this bigger rectangle is what? Total revenue, and cost is lower. Okay, average cost multiplied by quantity, which is the area of this rectangle. So cost is lower, and that is why you have the total cost, average cost is lower, so total cost also is lower, which means that the area of this bigger rectangle minus the area of this smaller rectangle gives you the economic profit, which is your this this rectangle. Okay, this region, this is your economic profit region. Okay, so this is very, very interesting. Okay, now what about long run equilibrium? We discussed the equilibrium price, but this was short to medium term, you can say. Now, economic profit, it actually attracts new firms. Okay, because in we discussed that barely, in perfectly competitive markets in the long run, firms barely earn any economic profit. Because if suppose there are economic profits, the economic profit will tend to attract new firms. Why? Because the barriers to entry are very low, products are very homogeneous, so obviously if the barriers to entry are very low, economic profit is, you can say, is a very powerful signal. Okay, it will bring new players, new entrepreneurs, okay, new farmers into the industry. And new entrepreneurs, they will try to replicate the same idea, same technology, they will compete for the same buyers, and they will also begin to supply output at the same market price. And this additional output, this will increase the industry supply, and that is why the supply curve will shift to the right. Okay, so in the figure, if you see, the supply curve will actually shift to the right. Okay. So yeah, entry lowers market price towards the minimum AC. Now, as the supply is increasing, you see the amount that uh, producers, you can say all the producers together, that output that the producers are offering at every price level, that output will increase because S has now shifted. This supply curve has shifted. Okay. So because of this shift now, the increase in supply, it will actually force the market equilibrium price a little down. Okay, you can see very clearly because now the intersection is happening on the right side over here. Okay, but the issue is, see, if suppose you have uh, say the industry, let's talk about the industry only. Okay, this was the earlier price curve 27.5. It is true for uh, individual firms as well as the industry. But now this entire supply curve has shifted to the right. So for the same amount of quantity now, I mean, because the issue is that at every price level, the amount of quantity, the amount of output has actually increased. Okay, so earlier at 27.5, okay, if let's say the equilibrium quantity was 475, but now you have a much higher quantity at that price. Okay, you have a much higher quantity at that price. Okay, so that is why the price will actually reduce, say in this case as an example, from 27.5 to 23.75. Okay, is this clear to everyone? Is this clear to everyone? Why is the price decreasing? Is this clear to everyone? Why is the price decreasing? This is your new
Sir,
price band now for every single firm as well as for the industry. Okay.
sir, I have one doubt actually.
Yes, yes, yes.
So the price decreasing part actually I didn't understand, but for the same price, the quantity might be increasing, right?
For the
So
same price, the quantity is actually increasing.
increasing. So where
Yes.
is actually the price lowering part? Actually, I couldn't get that actually.
See, again, we'll understand this logically as well as we'll try to apply this intuition to the graph as well. See, logically, if you see, earlier there was a structure where, let's say, a total number of uh, 475 units were being offered at 27.5. But now at the same 27.5, at the same 27.5, much higher number of uh, units are offered. Let's say, I will just highlight this part also so that you can understand it intuitively as well. And logically also, in fact, it's very, very consistent. Let's say this is the number. Okay. Let's say you have 650 over here. So at the same price now, 650 units are now being supplied. But you think about it. Has the demand changed? Has the demand changed? Who asked this question? I could not see the name earlier. Can you, was it Adil?
Yes, sir. Yes, sir.
Yeah. So Adil, tell me, has the demand changed?
No, no.
Okay. So if the demand has not changed, which means there is excess supply now in the market. Agreed?
Understood.
At that
Hmm.
particular price point, there is excess supply. So obviously, if you remember the demand curve, what happens? In the demand curve, if the quantity has increased, the price has to decrease. And even if you see logically also market participants, if they know that now the supply is more, who has more bargaining power now? Because there's a lot of competition, lot of supply. Who has more bargaining power, consumers or firms?
Consumers, consumers.
Exactly. And that is why the industry will have to force the prices down to reach a new long run equilibrium level, which will be actually lower than the earlier point, which will be, again, the logic will be the same. P is equal to marginal cost, and we have not drawn the marginal cost curve once again, but you can understand that the price will actually fall down. It has to fall down because now 650 quantity is available at the same price, but earlier 475 quantity was available at this price. Now, since the supply has increased without any increase in demand, the price has to fall. And that is why the new equilibrium price will be a little lower than the old equilibrium price. Is it clear now, Adil?
Yes, sir. Sir. With
Okay.
this, I think it would be much more clear if you plot this as 650 also. Now it's
Yes,
actually clear.
exactly. I
475
agree.
to 550
Exactly.
and
Yes,
650.
yes. I agree. Because actually, when I told this, I told that this is the point at which you have the new supply, but I think this should have been drawn like this. Absolutely
Yes,
agreed.
yes, yes.
So I'll
Yeah.
make sure it is there in the exhibit. We have this plotted everywhere. Okay, in all the three.
Hmm. All right, sir.
Okay. Yeah.
Understood.
Okay. So when you talk about again long run equilibrium, what happens? More and more players are coming. So earlier there was economic profit, but when more and more players will come in, the economic profit will actually become zero. So players will keep on coming in until you have positive economic profit, where we saw earlier. So until this shaded rectangle has some positive area, it means there is some positive economic profit. And this being positive means that the new players will keep coming in and they will keep increasing the supply. But since increasing the supply will mean that the prices will start to decrease, it implies that there will be a situation where you will have zero economic profits. Okay. So in the long run, you will have zero economic profit. The firm earns zero economic profit. But zero economic profit does not mean zero accounting profit. It does not mean that the firm is losing money, because we discussed that these two terms are very different. Economic profit is very different. Accounting profit is very different. Okay. Zero economic profit means that the firm is simply earning the exact amount of its required amount of return. That is the, you can say, the rental cost of capital, or the wage or the salary that all the laborers combined could earn elsewhere, or if the firm was doing something else, and the return on land, all those things, if they are fully covered, that is zero economic profit. Okay. And accounting profit may still be positive, but the only issue is that once you include the opportunity cost, your economic profit goes down to zero. Okay. So in the long run, the fundamental rule is the same. That's why I say this rule is very important. This rule is very, very important, that the equilibrium will only happen when marginal revenue is equal to marginal cost. So this rule does not change. The only difference is now that your AR and MR and price curve, it has shifted down. That is the only difference. Okay. And it shifts down at a very interesting point. Okay. Where it will just be a tangent to this average total cost curve, or average cost curve. For simplicity, I'll say average cost. Okay. So if you see, because it cannot go below this, it is not possible to go below this. Okay. You cannot go below the cost. You cannot take your price, which is below your minimum cost. That is not possible. Minimum level of average cost. That is not possible. So that is why this is the minimum price that this perfectly competitive market can go down to. It cannot go below this price. Okay, because below this price, what will happen? The revenue will be much lower than the cost. This is your minimum possible cost. So if this is the minimum possible cost, the price cannot go below this. Okay, so that is why this is your long run equilibrium point. Is this clear? Is this clear? Okay, great. So now take let's take an example. So let's say I ask, okay, can the demand curve based by firm A be perfectly horizontal while the demand curve for the entire market is downward sloping? Okay, so there are three options, A, B, and C. So please send your answers via private chat. Can the demand curve be perfectly horizontal while the demand curve for the entire market is downward sloping? Yes, absolutely correct. So which option is going to be correct? More answers, please. Even if you're not 100% confident, at least you can give your best intuitive guess. Consider this as a learning opportunity. That's it. You don't need to be 100% correct. Okay, so you can send your answers. Correct. This answer is also correct. Very good. So two correct answers. Okay, two more, I think, answers we have got. Correct. Okay, three correct answers are there. So the answer is option B actually. Okay, because buyers will switch to other firms if firm A is charging more than the market price, and firm A can sell its entire output at the previous. So for a single firm, it is possible that the demand will be perfectly horizontal, and that is what we have seen earlier. In a perfectly competitive market, the demand curve for a single firm was horizontal. But if you talk about market demand can be downward sloping. In fact, mostly it is downward sloping in the case of perfect competition. Okay, so option B is correct. Now let's go to monopoly. As I said that, although they have in the learning objectives or learning outcome statements, they have mentioned that for all four types of market structures, we have to discuss everything. But although they have clarified the differences between the four and they have discussed the basic characteristics of all the four, but they have only analyzed in the curriculum only perfect competition and monopoly has been analyzed in terms of the equilibrium, short term, long term, everything, pricing power. So the equational part, the graphical part has only been discussed for these two. So we'll start monopoly now directly. So of course, monopoly is at the opposite end of the market structure spectrum. Of course, completely away from perfect competition. So you have a single firm which supplies the entire market and consumers have no close substitutes which are available. Okay. So since the monopolist, it represents the entire market, the market demand curve is also the firm's demand curve because monopolist is the market itself, right? Okay, so this gives the monopolist, you can say, a very unique power. Okay, unique control over what? Over price as well as the quantity, the output. Of course, there are high barriers to entry, which gives a very considerably strong pricing power. Now, what are the sources? What are the sources of these barriers? So barriers includes patents, resource control, government authorization. Now this is one of the major sources. Patents, copyrights, you can say any form of legal protection. It is one of the very important source of monopoly power. Okay, so because you have patents and copyrights, what they do, they actually prevent others from copying any kind of innovation or any kind of creative output. Okay, so these uh, although it will not be permanent monopoly, of course, with respect to with these legal barriers, so these legal barriers, they can actually provide temporary monopoly. Okay, that monopoly will definitely you can say reward the firm for R&D, creative investment, all those things, but it will it be temporary. Okay, the second source is of course control over resources. Now one example which has been given in the curriculum book is regarding this company, De Beers. Okay, so based in South Africa, basically they controlled a lot of the world's diamond supply. Okay, so they owned a lot of mines and they had agreements with other producers and they were able to influence output and price for decades, and that was like monopoly like behavior only. Okay, and of course you can have government authorization as well, which is a common source of monopoly nowadays. Then you have natural monopolies. Earlier I discussed this. See, some monopolies will arise because it is economically much more efficient to have only one producer. Okay, that is what we call natural monopolies. Okay, uh, they will be characterized by very high fixed costs and economies of scale. In fact, significant economies of scale. Okay, I discussed the utilities part earlier, right? Water pipeline, sewer system, grids, electrical grids. Okay, because it's not only about cost. Of course, if you have to, if any other firm has to say duplicate all the infrastructure of, uh, say, this grid system, then sewage networks, duplicating these infrastructures, of course, it is costly, but it is inefficient also. I discussed this earlier, right? It is very inefficient also. There are a lot of hurdles, right? In fact, there are a lot of complications that can arise if electrical grids are duplicated by another firm. Okay, so that is why sometimes natural monopolies makes more sense. So as long as the monopolists long run average cost, as long as it decreases with the scale, a single provider is more efficient than multiple small competitors. And of course, nowadays such firms are regulated to make sure that the prices are reasonable and they are not exploiting, they are not earning excessive profits. Okay, they are earning normal returns. Then another source you can say is brand loyalty and also network effects, because not all monopolies will be from patents or resource control or because of cost issues or because of economies of scale natural monopolies. You can also have just because of, you can say, intense brand royalty, you can have a monopoly. And a very classic example which is also given in the CFA Institute book, and it's a very well widely discussed example, Rolex, right? Buyers believe that Rolex is uniquely superior and no substitute exists. That is what buyers believe. And when they are believing this, then the company can charge premium prices much above the competitors. Okay, so this brand created royalty, it itself is a barrier to entry, because if a new firm is coming, it will not be able to easily replicate, you can say, years and in fact sometimes decades of status, attachment, reputation, all these things will not be able to, will not it will not be able to replicate. Okay, then you have network effects, and it is a relatively modern source of monopoly. And as more and more, so the idea is that as more and more people are using a product, it actually becomes more valuable. Okay, so the PPT that we are using right now, it actually is a very good example. Okay, Microsoft products, Office products, basically all of them, in fact, not only PowerPoint, but Word uh, and PowerPoint. Basically, these two and other products as well. Outlook, Word, PowerPoint. In the education industry, OneNote is very strongly used. But anyways, let's stick to say PowerPoint and Word. Most of the people, I mean, who are using personal computers, okay, they already know how to use it. So if suppose the firm has to hire new employees, the firm will avoid training cost on at least Microsoft Word and PowerPoint. And these documents and PowerPoint presentations, they are actually compatible across all organizations. Okay, so basically the idea is that if a product is has reached a very high adoption rate, then each new user, it will increase the value of the network and it will make the alternatives much less attractive. And this is what we call as a self reinforcing cycle. Okay. Now, demand and marginal revenue in monopoly. So monopolist, they face the entire market demand. So the firm itself is the industry, no competitors exist, and the monopolist is facing the aggregate market demand for that product. Okay, so obviously the monopolist demand schedule is downward sloping, just like any market demand curve. Okay, because of the same, the effects that we have done earlier, right? We have done income effects, substitution effects, all these effects. Okay, so price, as the price increases, consumers will purchase fewer units, and of course as the price decreases, then the quantity demanded rises. That was a downward sloping curve. So what is was the general, if you take a general example, again, you can take numbers also, but just because we have already taken examples using numbers, so let's take example using coefficients directly. So this is an example. QD is equal to A minus BP. So if you rearrange the terms and you find out the inverse demand function, which is actually the uh, using which we draw the demand curve. So this is your function, inverse demand function for the demand curve. P is equal to A by B, or A over B minus 1 over B multiplied by Q. Okay. So as quantity increases, you have a negative slope. As Q increases, P will decrease. So what is total revenue? Total revenue is equal to P multiplied by Q, and marginal revenue will be equal to delta TR divided by delta Q. Okay. Now, one thing which we have to understand is that they have used a little bit of calculus to demonstrate some of the things, and it is used regularly. I'm seeing not only in the prerequisite but later on also. So uh, even if you don't understand calculus, it's completely okay. I'll just uh, recollect. I'll make you guys recollect some of the very basic derivative rules. Okay, so we are not going into the details. So let's take an example. Okay, so if suppose I take this example, yeah, that's correct. So in this case, okay, P multiplied by Q. So total revenue, if you see, in terms of quantity, if I want to find out, see, P is what? P is nothing but A by B minus 1 over B multiplied by Q. And this is P, and if you multiply it by Q, what do you get? You get A over B times Q minus 1 over B times Q square. Okay. So to find out marginal revenue, you actually take delta TR by delta Q. Okay. So basically the idea is, for a small change in Q, what will be the change in total revenue? And generally, if you do it algebraically, methodically, you can take delta Q as 1, you can verify it with numbers also, you'll get the same result. But using the language of calculus, they have done it. So basically the idea is that this delta has been replaced with a partial d, or a partial derivative. So basically, instead of calculating delta r by delta q, we actually calculate the derivative of tr with respect to q. I'm taking more liberty because uh, I could have written dtr dq, and that would also not be incorrect, at least in this context. But I use this dow we call it in calculus language. This is partial derivative. Now, when I say partial derivative, it means that you only differentiate with respect to q, keeping others as constant. Okay, at this level, you don't need this. Don't worry about the calculus part or partial derivative or derivative part. You just need to understand the interpretation. Okay, but in this case, even if you take the full derivative, there will be no problem at all because there is only one variable, which is q. Now, this partial derivative, which makes more sense when you have more than one variable. So this partial derivative is a general case which actually covers everything. Anyways, let me just take the derivative. Now, I'll just give you one formula. If you remember this from school days, okay. If you remember, ddx of x raised to the power n will be equal to, and this will apply for partial derivatives as well, okay, n multiplied by x raised to the power n minus 1. Anyone who remembers this formula from school days? Again, I'm saying it's not required for the CFA exam, so do not worry at all. But just out of curiosity, anyone who remembers this? Okay, Vivek. So if you want to differentiate this with respect to q, what will you get? So differentiation of q with respect to q, if you apply this formula, it will be 1. So this will become a over b. And differentiation of q square is how much? If you apply this formula, n minus 1, in the power you have n minus 1, which means 2 minus 1. So 2 minus 1 is 1, which means q will be raised to the power 1, and this n will be multiplied. So 2 will be multiplied, right, over here. So basically dd q of q square is nothing but 2q. So that is why you have a 2q over here, minus 2q. And since this was a constant already, okay, b was a constant, so it will just get replicated like this. Okay. Okay, Jashankar also remembers. Great. So this is how the marginal revenue can be calculated. A by B minus 2 by B times Q. So the slope of the demand curve represented by the price function or the inverse demand function is negative 1 over B. Do you agree? The slope is given by negative 1 over B. Now the basic formula, if you remember, is y is equal to mx plus c for the straight line. So whatever is multiplied by m, that is your slope. So m in this case is negative 1 over b because this is your independent variable q. So for this line, p is equal to a by b minus 1 by b times q, the slope is negative 1 by b or negative 1 over b. Can you tell me what is the slope for this line? For marginal revenue? So marginal revenue becomes equal to a by b. Again, I'm writing this once again. A by b minus 2q by b. So if we plot marginal revenue versus quantity, we get this line. Can anyone tell me what is the slope of this curve, this line? Anyone who can tell me just by looking? Very good. Excellent. Both of you are correct. Yeah. So the slope is actually negative 2 over b. So what is the difference between these two slopes? What is the relationship or what is the difference basically? Whatever you are seeing over here, negative 1 over b, is this double of that? Agreed? Is this double of that? So the slope of the demand curve is negative 1 over b, and the slope of marginal revenue versus quantity, so marginal revenue curve, is negative 2 over b. So can I say that the slope of MR is double that of demand curve? Do you agree or not? Yes or no? The slope is double. And since both of them are negative, so basically both of them are falling. Okay, negative means falling. Negative means the line is actually moving downwards. Okay, so since the slope is double, I can say that marginal revenue, it actually falls faster than the demand, and in fact twice the slope when it is linear. Twice the slope when it is linear. Okay. So I'll not erase everything in this slide right now, but actually the next diagram is going to be overlapping over here. Okay. So give me 1 minute. In fact, I'll rearrange because I don't want this to disappear. For those of you who are curious how this relationship was derived and how we know that marginal revenue is actually falling at twice the speed as compared to the demand curve, this derivation is very, very important. So just give me 1 minute. I'll just rearrange the slides. Yes, so we are back to the slide. Shankar is asking, can you repeat? Yes, Shankar. This part, the twice part, Shankar, why it is falling at twice the rate? This part you want me to repeat? Okay, got it. So see, what is the slope of this line? The slope is -1 over b, correct? This is okay with you? Slope is -1 over b. You answered this in fact. For the marginal revenue, when we actually differentiated the total revenue with respect to Q, we got MR is equal to A over B minus 2 over B times Q. So this, if I put it in brackets with Q, this part separately. Okay. So can I say that the slope for marginal revenue line is -2 over B? Do you agree, Jashankar? -2 over B. This is correct. Okay. So what is the relationship between these two slopes? Is this, I should say, is this double of this? -2 by B is double of -1 by B. Simple. Okay. So since the slope of the marginal revenue line is double that of the demand line or the demand curve, that is why I can say that the marginal revenue falls faster than the demand with twice the slope when they are linear. Is this line clear now? Because if the slope is double, obviously the fall will also be double, na? It is more steep. So if something is more steep, depending upon the direction, depending upon the sign, whether it is positive or negative, depending upon that, it will rise or fall at a double speed, right? So yes, since it is negative, correct. Since both are negative, that is why both are falling. But one of them is falling at a double speed than the other. Okay, so I think it's clear now to you, right? Shall I proceed? Got it. Okay, great. Next. Yeah, so same line I've repeated, and this is the curve now. So you can see that this is falling and this is falling at a double speed. This is falling more quickly, and that is why it falls to zero much more quickly. Okay, after this, it becomes negative. So just out of simple calculation, if we do over here, if we do a simple calculation, let's say you have quantity QD over here. So can you tell me what will be the quantity over here since it is falling at a double speed? So just by a very basic simple calculation, can you tell me if this is QD, what should be this? If it was falling at a double speed, anyone who would like to answer? Very simple. You just put price as 2 in that uh, marginal revenue function. That's it. Price as 0. Sorry. Yeah, Q by 2. Correct. Exactly. Since this is going to be falling at a double speed, this is half of this quantity actually. So marginal revenue becomes 0 at QD by 2. Now, why I am doing this? Because there is a very important point that the curriculum has mentioned later on, but no explanation is given for that point. So just this point is being mentioned so that the explanation which we'll give later on becomes more clear. And if you want to get the exact value q by 2 or qd by 2, you can simply substitute. Na? Price is 0 at that point. So if you substitute in this equation, sorry, marginal revenue is 0 at that point. So if you just substitute MR equal to 0, you will guarantee it, you will automatically get half of that quantity. Okay. So you can check it actually. Very clearly, you'll get the answer. It can be derived. Okay. And in monopoly, the average revenue is same as the demand curve. So you have three kinds of curves. Two of them are same. Basically, the demand curve is equal to same as AR. Now, in the perfect competition case, price, average revenue and marginal revenue, all three were same. In this case, only the price and average revenue are same. The marginal revenue is different. Okay. So this is the price curve. You can say P equal to AR basically. Okay. AR equal to demand curve means price is equal to AR, because demand curve is what? Demand curve is nothing but the price. Price as a function of quantity. So price is equal to AR, you can say in this case. Okay. So this falls at twice the speed. Now, monopolists, they based output on cost and demand, not on the supply curve. Okay, not on a supply curve. So the firm is not taking the price from the market. It is facing the entire demand curve and it is choosing the quantity that maximizes the profit. Okay, so the output is depending upon two things. You have market demand, okay, and the firm's own cost structure, not any supply curve. There is no unique supply function which links price and quantity. See, in a perfect competition, we could describe supply as a direct relationship. If you remember, it was a line with a positive slope. We were choosing that as an example. You can describe supply as a direct relationship between price and quantity. And mind you, all of you, I'm saying this. See, today we are taking very simple example of linear functions, but it is, of course, it is not necessary that it will be a linear function. But linear function is a very special case and a special example to keep things simple. Okay, because you can draw the line, geometry is easier, but in reality, it's actually not a straight line. They are far from a straight line, the demand and supply curves. Even theoretically, they are far from straight lines. They are just simple examples. So in monopoly, you cannot describe supply as a direct relationship between price and quantity. That is impossible, because price will be determined only after the monopolist will choose the profit maximizing output. So there is no such thing as a monopoly supply curve directly. Okay. Now, the total cost will be used to derive marginal cost as cost of extra output. So if we have to decide how much to produce, the monopolist will use the total cost function. Okay, so no curve is required, just the total cost is required. Okay, and this from the total cost, you will calculate the marginal cost, which will be and of course marginal cost. The definition is same. Marginal cost is just the cost of producing an extra output. Okay, and then you have the same AC curves and MC curves will be there. See, one thing I just want to repeat once again. See, when I say no need of supply curve, I'm not implying that no need of marginal cost curve and no need of average cost curve. These things are still important. Okay. So if you take any example where you have a total cost, again, marginal cost you can find just by differentiating it. So I'll just give you one example, and based on the formula that I had highlighted, the same formulas, because I'm going to give you a quadratic structure, q square one. So you tell me what is the marginal cost. So if I give you TC is equal to 9,000 plus say 30Q plus 1.5 Q square. Can you tell me what will be marginal cost quickly? Just differentiate this with respect to Q. Those who know this, they can give the answer. Those who are not remembering it completely okay, not a problem. Okay, I'm writing the same derivative structure over here. ddx of x raised to the power n is equal to x raised to the power n minus 1 multiplied by n. Okay, so same formula is being used. So using this, can you tell me, and for a constant it will be 0. So the derivative, the rate of change of 9,000, since it's a constant, it's not changing. So the derivative of 9,000 is 0. This is a fixed number. So I'm writing this once again. So d dx of a constant k is equal to 0. So the ddx of first term, ddq of first term will be equal to 0. Okay, Jashankar has given 3q plus 30. Absolute 3q plus 30. Perfect. Perfect. So basically, the first term, the derivative will become 0. So you can say 0 plus, for 30q, it will become 30. And for 1.5 q square, since 2 will be multiplied to 1.5, it will become 3 q raised to the power 1. So 30 plus 3q, absolutely correct. Okay. So this is the curve now. These are the curves. So you have marginal revenue over here, demand, which means demand is representing price as well as average revenue, if you remember. Okay. So the fundamental rule of profit maximization still stays the same. You have the profit maximizing output. Just a minute. You have the profit maximizing output where again marginal revenue is equal to marginal cost. So that does not change. So this is the marginal revenue and this is the marginal cost. So marginal cost is 30 plus 3q, let's say. Again, this region let's not consider. This is my example which I have given hypothetically. It's not for this particular curve. Okay. So let's say we are in this zone where marginal costs are increasing and you have the marginal revenue over here. So this is your intersection point. Okay. So this is my intersection point. Now in the book, one thing is mentioned which for which I told you guys that they have not given any explanation. They have mentioned that this occurs at the elastic region of the curve. This equality, so this part occurs at the elastic region of the curve. And to understand this only, I gave the earlier explanation of QD by 2 over here. Because the explanation is not given at all. And it will be very difficult to understand if you don't have that geometrical intuition. So we'll understand this quite intuitively. See, marginal revenue, it ends or it becomes 0 at half of this quantity. Okay, which means the x coordinate is half of the x coordinate of this. Now, if you extend this half, okay, basically why it is saying that this QDE is in the elastic region, because it is to the left of the midpoint. It is to the left of the midpoint, right? And do you remember in a demand curve, if you are in the left of the midpoint of the curve, are you in the elastic region or inelastic region? Tell me. Because if this is the midpoint, it means this is also the midpoint. I mean, if you can just trace it vertically, it will be easier for you to understand what I'm saying. So if you just trace it vertically, this part, okay, this is the midpoint. Trace it vertically and you reach the midpoint of the curve. Okay, so let's say this is the midpoint of the demand curve. Can you tell me at the midpoint of the demand curve what is the elasticity? At the midpoint of the demand curve, what is the elasticity? Perfect. Yes. Correct. Very good, Vivek. Yes. So to the left of this midpoint, is it elastic region or inelastic region? To the left of this midpoint, is it elastic region or inelastic region? Exactly, elastic region. And that is why this happens in the elastic region of the curve. So once you build this geometric intuition, things become quite clear to you. Okay, anyways, let's continue with our example. So let's have the same example. Okay, so this 9,000 plus 30q plus 1.5 q square. This is the total cost, and we find out the marginal cost. Now, I think that example, okay, actually the details of this example, it should have been given. It is not mentioned over here. It is not mentioned over. Anyways, I'll just tell you the details. So I'll just write it for you. So quantity, if suppose this is the function, for this example I'm telling you, where we get the answer as 65. So let's say if it is 300 minus, say, 3 by 4 times p, or let's just divide 3 over by 4, we'll get 0.75. So let's say 0.75 times p. Okay. If you invert it to find out the demand function, you will actually get p is equal to, you can check it, you will get 400 minus 1.33 times q. Basically, this is 3 over 4, right? Okay, 3 over 4 times p, and that is why if we just take it to the other side, okay, so it will become basically 3 over 4 times p is equal to 300 minus q, and just multiply everything by 4 by 3. So 4 by 3 times 300 becomes 400, and this will become uh, 4 by 3 times q will become 1.33 times q. Anyways, you can check it later on. So this will give you total revenue will be equal to price multiplied by quantity. So if you multiply p by p with q, you will get 400 q minus 1.33 q square. And if you differentiate to find out the marginal revenue, so marginal revenue is equal to, again, partial derivative or full derivative does not matter over here because there's only one variable. So I can take dd of tr, okay, ddq of tr, or delta tr by delta q. This is equal to 400 minus, now again 1.33 will be multiplied by 2. So 2.66 times q. Okay. So this is your marginal revenue, and let's say this was your marginal cost. So just equate them and tell me what is the quantity you are getting. So I'm writing once again, marginal revenue is equal to marginal cost. Tell me what are you getting as q. Tell me what are you getting as q quickly. How much you are getting as q? Please solve and send your answers. Okay, so you're getting close to 65 only, right? Correct. Perfect. So this is what we are getting, 65 units. Okay. So if this question is asked in the exam, you can calculate the price also. You can just substitute the value of q in this equation. You will get the price also. So price can be found out after quantity. Total revenue can be found out. That will be your total profit maximizing revenue. Okay. Total revenue at the profit maximizing point, you can say, or at the profit maximizing quantity, you can say. Similarly, you can find out total cost also because you already have the total cost function. And once you subtract both of them, total cost minus, total revenue minus total cost, you will get the total profit as well. Okay. So in this case, if you substitute P in this equation, so you will get Q. So we have got Q as 65 approximately. Okay. And if we substitute 65 in this equation of P, okay, we are going to get P as 313.5, close to that, 313.5 or 55, something like that. So 313.5. Okay. Now you have P as well as Q. So if you have Q, you can calculate your total cost quite easily. Okay, so this is your assignment. Okay, just make sure that you calculate the profit for this particular example. So you can calculate the total cost with Q is equal to 65. You can calculate the total revenue also. Okay, multiply by P by Q. So you have P as 313.5. Okay, so total revenue will be P multiplied by Q. So 313.5 multiplied by 65, that will be your total revenue. Total cost, you just plug in Q in this equation, the total cost equation. Then you get profit as total revenue minus total cost. And please send your answers after the class once you solve it. Okay, you can send it on Telegram via DM or in the group. You guys can discuss among yourselves and see what is the correct answer. Next, now let's discuss the optimal price and output in monopoly markets. Okay, now monopolist will choose the output, of course, where marginal revenue is equal to marginal cost. So based on the monopolist, of course, we have decided this already. Okay, so we are considering now long run, where regulations can also come into picture. Okay, so this part we have discussed that, okay, for the monopolist this is the best. The monopolist will try to maximize the profit where the marginal cost curve, it cuts the marginal revenue curve. Okay, so at this point basically this will be the quantity, and since this is the demand function, so for this particular quantity the monopolist is getting this price PM. So this is the profit maximizing output price for the monopolist PM, and the profit maximizing output quantity for the monopolist QM. Okay, so price we have taken from the demand curve PM. Okay, now you see price lies considerably above the average cost, considerably above the average cost. So it means that there is a lot of economic profit. Okay, but total revenue is this price times this quantity. So this entire rectangle is your total revenue, the area of this rectangle. And what is the total cost? What is the total cost? Just see the average cost curve. Okay, for this particular quantity, what is the average cost? This is the average cost. So basically you have to extend from here and this rectangle. So the idea will be same. This will be the total cost and this area will be your economic profit. So the same thing that we have done earlier. Okay. But the issue is that since there is a lot of economic profit and you have a total revenue, which is the price quantity rectangle, and you have the total cost, which is the rectangle under the AC curve, which is not drawn here properly because this is the AC curve. Okay, it should actually have been drawn over here like this. Yeah, this is the average cost curve. So basically this rectangle, the area under this rectangle, okay, this rectangle is your total cost curve and this is your economic profit. Okay, so this is the situation. But there is a problem. Profit also we have seen the vertical gap between demand and AC. So this is your profit basically. This part. Okay, not PR. PR is something else. Now there is an issue. The issue is that this cannot continue. I mean, this may be deemed to be too much. If suppose there are regulations, this may be deemed to be too much. So it is possible that the regulator might just regulate the price up to this point where only the average cost is being covered. Only the average cost is being covered. This is possible. Okay. Had the market been perfectly competitive, in fact, the price would have been reduced to PC because in perfectly competitive markets, we see where the marginal cost is cutting the marginal revenue, and for marginal revenue for perfectly competitive market, it is same as the demand curve. Okay. But because it is a monopoly, marginal revenue curve is different. But had it been a perfect competition, the quantity would have been this much and price would have been this much. So this is what has been shown in the graph. So this is for the case if it were a perfect competition. And this is the case of regulated. And this is the case of profit maximizing monopolistic case. Profit maximizing monopolistic case. Okay. So that is the difference between QM, QR, and QC. Now let us come to next point, which is price discrimination and consumer surplus. Now monopolists, they will vary prices to extract consumer surplus. Okay, so first we need to understand what is price discrimination. See, price discrimination is what? It's a very basic concept. Situations where sellers, they charge different prices to different customers for the same product. Not because the costs will change or differ, but because the willingness to pay of the customer is different. Okay, so any firm with any kind of pricing power, they actually they can design strategies that will convert some of the surplus or all of that surplus into profit, and they do it through price discrimination. So first degree price discrimination. Okay, it represents the most extreme case. So here the seller is charging every customer, every buyer, their maximum willingness to pay. Okay, you can just think of some basic examples like say car dealership. Now, when you go to a car dealership, the price is although nowadays there is less limited flexibility nowadays we are seeing even in car dealerships, but you can say that the negotiations are carried out individually, right? And it is possible that if suppose the seller is knowing, and nowadays these things are much lesser in practice. I think 10 years back there was a lot of negotiation in price in car dealerships also. If the seller knew exactly how much each buyer was valuing the vehicle, the seller actually could capture the entire consumer surplus of that customer. Okay, and this is not preferred by regulators as well as even economists. They don't prefer because the monopolist is kind of exploiting. It is extracting all the value and it is leaving no surplus for the consumers. Okay, and of course it is very very rare to achieve it perfectly because the exact knowledge of each and every customer's preferences cannot be known completely, right, to perfection. Then you have a second degree price discrimination. So in this case, rather than identifying the individual willingness to pay, you can say the seller will offer a menu of quantity or quality options for self selection. The customers can directly sort themselves into category that you can say best is suiting or matching their valuation. So you can have examples like volume discounts, electricity tariffs, even coupons. Okay, different product versions in cars also we are seeing, right? I mean, if a car is launched, there are separate price bands for separate versions. In fact, for car there is a lot of differentiation, so that example does not fit perfectly over here. But yeah, you can have say nowadays we are seeing OpenAI, right? For students, the plan is completely free, right? So for users who are say utilizing at a basic level 5 GB, 10 GB for any kind of software, maybe the pricing can change. Okay. Similar, as I said, for OpenAI, for students it is zero. For Go plan in India, it is 399. For enterprise plan, you can go ahead and maybe it's something else. For professional, it is 1999. Okay, so customers who value the product more, they will tend to buy either larger volume, you can say, or a higher quality tier. Okay, so this self selection is quite common nowadays in digital media, especially digital space, and even in the retail space. Then you have third degree price discrimination. Okay, it separates the consumers into different groups with different sensitivities to prices. Okay, we have a very common example nowadays which is happening, because you can check this. In fact, uh, it is very commonly observed that if you're say booking a ticket for a round trip, then the same day round trip will probably cost a little higher than a multi-day round trip, which sounds quite strange, right? Because the airlines, they know that the same day round trip passengers, they are typically business travelers. They have probably a higher willingness to pay and their fares will be more expensive. Although in India, we'll find that the price difference may or may not be there. It will be there sometimes, and even if it is there, it will be a little, you can say, very, very low. But in developed countries, you'll find that these differences are much higher. Okay, so uh, you can say by tailoring these kind of prices, firms will capture more amount of revenue. Okay, and in fact, that student example which I gave, I think that should for OpenAI or other softwares, I think that should fall under the third degree only, because that's a group, right? Yeah, and they are, but they are also doing self selection. So I think student one can fall in either second degree or third degree. Okay. Now the logic is of course the same. The strategy aims to convert the surplus into profit while expanding output. Now let's talk about long run equilibrium. So long run, it allows all inputs, technology and scale to adjust. Okay, so monopolist is no longer restricted by fixed inputs. Maybe short term, there can be some inflexibility. Okay, but in the long term, technology changes, the monopolist can expand or reduce capacity, change the inputs. So that kind of flexibility allows the monopolist to operate more efficiently. Okay, but of course, that means that monopolist also should make strategic decisions that will consider future costs, not just short run constraints. Okay. Now, economic profit will persist only with strong entry barriers. We have seen what happens in a perfectly competitive markets. All the long run economic profits, they actually disappear because new firms are entering the market. But the in monopoly, the firm will keep earning economic profit because of strong entry barriers. If suppose entry to barriers reduce, then even for monopolist, economic profits will start to decrease and gradually disappear. Now, for unregulated monopolies, output will be at marginal revenue is equal to marginal cost, as we saw earlier, which is much higher above the average cost. Okay, so basically, the monopolist was facing the entire market demand curves, and that is why uh, the point at which MR was equal to MC, if you remember, it was at the elastic region and the price was much higher, okay, because we wanted to check on the demand side, demand curve, but the MR equal to MC point was much lower than that. Okay, so what are regulated solutions? So maybe the price can be equal to marginal cost with some subsidy. When a natural monopoly is being regulated, like the utilities one, okay, this is actually a socially efficient solution. Set the price equal to marginal cost. Okay, this actually, the issue with this price equal to marginal cost is that the firm can lose money sometimes because marginal cost is below the average cost, especially in the beginning when fixed costs are large. In fact, if you see the diagram, it's quite clear, right? Every diagram. In fact, you see marginal cost is much lower than the average cost. In fact, marginal cost starts to go above the average cost later on. Okay, so if you set price equal to marginal cost, it is a much lower cost and the firm may actually lose money. So the solution is give subsidy to those firms. Okay, give subsidies to the firms if they are making any kind of loss to cover that shortfall. Okay. Now, what are another solution is to make price equal to long run average cost. Okay, so this case it is actually more practical. Regulator, and that is what we saw earlier. Okay, that the regulator can set the price high enough so that at least all the costs are covered and they will earn a normal return on the capital. But of course, it will not be high enough to earn any kind of economic profit. Most common approach you can see in regulated industries. Then you have nationalization or regulated monopoly. So in some countries, the government can simply own the monopoly. So we have seen many, there are many examples in many countries, including India. Okay, you have postal services. Okay, even there were earlier BSNL was also owned. Okay, although the telecom industry it's been a long time since it was a monopoly, so that example does not apply. But earlier 20 years back, the then you have this railways also, right? So another long run approach is to award the monopoly rights through competitive franchising or competitive bidding process. Okay, so any firm which will offer to operate at around this cost, LRAC, they will win the contract. Okay, and this is again quite common in many countries, including India, and we have seen this example quite a lot recently, especially in airports. Okay, airport shops, uh, different public transport routes. Okay, even stadium concessions for stadiums also. Okay, so overall, you can say the the overall long run equilibrium outcome for any monopoly, it will depend heavily on these entry barriers as well as these regulatory choices. Okay, so unregulated monopolies, they will actually earn profit, economic profit, because the price is above average cost. But regulated monopolies, they will be pushed towards lower prices. Okay, that either they will reflect marginal cost or at least long run average cost. If subsidy is not possible, then at least this is a more practical solution, because it kind of balances efficiency with affordability. Okay. Okay, fine. That's it for this prerequisite reading. Thank you very much. I'll just end the chapter now. Thank you.